Hey guys, welcome to the 10X Academy. I am your host JR, and in today's video, I'll be discussing a simple guide on how to invest in the stock market. This strategy uses two of the 7 primary flows of income, primarily dividend income and capital gains. And as we all know, creating passive recurring income is the key to creating wealth. Stay tuned till the end of the video to help grow your portfolio from scratch to a freedom-sustaining passive income producing flow to help you reach financial independence and retire early. The key points in developing an income-producing stock portfolio include capitalizing on the 2 main sources of income for stocks, namely dividend income and capital gains. Diversification is key to minimize risk. There are several methods of diversification which will be covered in this video. Consistency by employing dollar cost averaging is key in growing your portfolio to a dividend income sustaining asset. Using the principles of value investing are important when buying or selling equities to capture capital gains on stocks that have appreciated in value over time. The keys to value investing are A. Knowing when to invest money safely in an undervalued asset. B. Being able to calculate your risk of investment. C. Being able to see its future value. And D. Collecting a return on your investment or ROI while the asset is appreciating in value. This is typically in the form of dividend income and capital gains. By investing in the value of companies, one can minimize the risk and maximize the profit potential of an investment. A simple rule for investing in stocks for beginners is to use the principles of value investing and dollar cost averaging your positions while collecting dividends along the way. For more information on value investing, check out my video, Value Investing for Beginners, The Intelligent Investor. Return on investment should include 2 key flows of income, which I have discussed in a prior video titled How to Create Multiple Flows of Income. These 2 flows are dividend income and capital gains. Dividend income is earned from stocks or mutual funds that pay dividends, usually paid quarterly or every 3 months. Risk is higher since assets can depreciate over time. However, losses are tax deductible. Dividend income is more of a long-term strategy play where assets are accumulated slowly and dividends are compounded to grow the investments. Capital gains is when an asset gains value or appreciates over time. In the case of stocks, the value of the stock has gained value over time. In order to take advantage of capital gains and avoid heavy taxation of this type of income, stocks should generally be held for at least 1 year. Capital gains provides the lowest tax rate for this type of income, similar to dividend or rental income. Taking advantage of both of these types of income while taking advantage of the fundamentals of investing is the key to creating long, sustaining wealth. To summarize, there are 3 critical factors to investing. 1. The time period of investing. 2. The strategy used to invest. And 3. The allocation of principal to invest. It is helpful when selecting stocks you'd like to invest in to diversify your portfolio of stocks. Diversification using several strategies helps mitigate losses when the economy takes a downturn or certain sectors have downturns, or even when a particular business has a bad quarter or a bad year. Now I will go into different strategies of diversification to apply to your portfolio to help mitigate risk when selecting stocks. Sector diversification. There are 10 main sectors in the stock market. Energy, which is oil, gas, and charcoal. Examples of this sector are Exxon, Shell, Chevron, and BP. Basic materials, which consist of chemical, metals, and construction materials. Examples of this are Dow, DuPont, Valvoline, and Sherwin-Williams. Industrials, which is defense sector, machinery, airlines, constructions, and manufacturing. Some companies in this sector include Boeing, 3M, UPS, Delta, and Caterpillar. Consumer discretionaries, retailers, apparel, restaurants, autos, and hotels. Examples of these are Amazon, Home Depot, GM, Starbucks, and Target. Consumer staples, which are food, beverage, and tobacco. Some companies in this sector include Coca-Cola, Procter & Gamble, Kraft Heinz, and Philip Morris. Healthcare sector, which includes pharma and healthcare equipment and services. Some companies in this sector include Johnson & Johnson, Pfizer, Merck, and United Health. The financial sector, which are banks and insurance. Companies in this sector include JP Morgan, Bank of America, Goldman Sachs. The information technology sector, which is commonly known as the tech sector, Some companies in this sector include Apple, Intel, Microsoft, Facebook, and Google. Communications sector, which consists of companies like AT&T, T-Mobile, and Netflix. The utilities sector, which includes electric, water, gas utilities. Some companies in this sector include the Duke Energy, NextEra, and PG&E. And finally, the real estate sector, which includes REITs and real estate developers. Some companies in this sector include Simon Property Group and Realty Income Corp. Regional diversification. Diversifying both domestic and international stocks is a great way to mitigate risk across world economies. Two great funds to build upon your diversification strategies are the Vanguard International High Dividend Yield ETF, or VYMI ticker symbol, and the Vanguard Total International Stock ETF, stock ticker symbol VXUS. These are both great dividend ETFs while concentrating on non-US stocks to give your portfolio an international balance. Market cap diversification. Market capitalization is defined as the value of all outstanding shares of a corporation times the market price. Market capitalization diversification involves diversifying your portfolio across the different market caps, small, medium, and large. Small cap stocks have a market capitalization between $250 million and $2 billion. Medium cap stocks have a market capitalization between $2 billion and $10 billion. And large cap stocks have a market capitalization greater than $10 billion. The smaller the market cap, the more volatility the stocks experience. But with more volatility comes the potential for more market gains. Ideally, you would want some exposure in your portfolio to small and mid caps, but concentrate the majority of your portfolio on large caps that are more stable. Market caps can also be diversified further between US and international. Some small and medium US market cap ETFs that can provide good diversification include the Wisdom Tree US Small Cap and Medium Cap Dividend Funds, ticker symbols DES and DON respectively. Dollar cost averaging is a strategy that allows an investor to buy the same dollar amount of an investment on regular intervals. The purchase happens regardless of the asset's price. As the price goes up, you average up, buying less of a stock, but nonetheless still building up your position in that stock. As the price drops, you're averaging down, buying more quantities of the stock, building up your position as well. On average, over time, the appreciation of the stock as well as the dividend reinvestments allow the position to gain value over time, and its value compound over time. Money compounds from two factors: capital appreciation of a stock plus dividend reinvesting. Time is of the essence. The more time you invest, the greater the compound effect. M1 Finance is a stock brokerage app that allows investments in small amounts and fractional shares to be purchased of any stock. M1 Finance also has a rebalance feature where you can rebalance your portfolio at any time to sell shares of stocks you are in profit in and buy more shares that you are down relative to the rest of the positions in your portfolio. Investment of funds or dividend reinvestments automatically get allocated to stocks that are relatively down in your portfolio versus buying more shares of stocks that are up. Click the link in the description to start using M1 Finance and get $10 toward your first stocks when you sign up now. An example of a diversified portfolio that meets all the requirements of diversification across asset class, global, sector, as well as market cap is shown here. This portfolio includes the following funds: VYMI, the Vanguard International High Dividend Yield ETF. This has a dividend of 3.82%. Noble, ProShares S&P 500 Dividend Aristocrats ETF, and this has a dividend of 1.47%. DON, D-O-N, this is the Wisdom Tree US Mid Cap Dividend ETF, and this has a dividend yield of 5.84%. DES, it's the Wisdom Tree US Small Cap Dividend ETF, and this has a dividend of 7.42% yield. DLS, this is the Wisdom Tree International Small Cap Dividend ETF, and this has a yield of 2.32%. And finally, DIM, the Wisdom Tree International Mid Cap Dividend ETF, and this has a dividend yield of 2.57%. This diversified portfolio generates an average dividend yield of 3.54% and is fully diversified based on our criteria, with minimal risk and maximum returns potential. If you're interested in using this portfolio, click on the link in the description for the exact portfolio to start investing. Time in the market versus trying to time the market is key in investing. Invest for the long term and compound ROI, or return on investment, which is basically the appreciation of the stocks and the dividends paid out, reinvested. Continue to invest capital on a regular basis using dollar cost averaging to make your portfolio grow over time. The ideal appreciation curve of your portfolio over time should look like this. Remember to check out the links in the description to start investing in the stock market using simple to use stock investment apps that are commission free. Thank you for watching this video, and don't forget to subscribe for more wealth creation videos and hit that like button if you enjoy watching content like this.